You are watching the 5-minute chart, and it is barely moving. The final candle just hovers there, trapped in a tight, motionless range. The market has been open for 2 hours. Price is chopping sideways. You have scanned all your primary tickers, and absolutely zero high-probability setups have materialized. You know your trading plan inside and out. You know you should sit on your hands. But staring at that flat line, you start scanning the screen, actively looking for any tiny excuse to enter the market. You spot a pattern. It is a low-quality C-tier setup that you would normally ignore on a busy morning. But right now, you click buy. Almost instantly, the momentum reverses. The market moves against your position, and an immediate sinking feeling of regret washes over you. You have spent hundreds of hours studying price action, risk management, and market structure. Yet here you are, manually executing a trade you knew was weak before you even placed the order. Why do we knowingly break our own strict rules, even when we fully understand the financial consequences? The force destroying your execution in this scenario is a completely misunderstood internal trigger: boredom. Staring at a motionless screen for hours creates a biological deficit in the brain. Your sensory system demands engagement, but the environment provides none. This diagram illustrates stimulation seeking, a hardwired human trait. Deprived of input, your brain sets off an internal alarm. When the market fails to provide valid input, your brain manufactures excitement, physically compelling you to act just to feel engaged. Executing a weak trade during a slow, choppy session is simply your nervous system attempting to cure its own boredom. Rewind to that exact moment of boredom. From here, we track 2 potential reactions to a slow market. Following the upper red path, the emotional reaction, your goal shifts. You abandon a mathematical edge, and your primary objective becomes finding stimulation. Because of this shift, your attention scatters across irrelevant data. You start dropping down to lower timeframes, and carefully planned risk parameters are completely ignored, just so you can feel like something is happening. Now, trace the lower green path, the valid plan. Here, the disciplined trader feels the exact same boredom, but notices the urge to take a weak trade. Instead of clicking, the trader successfully pauses. They observe the biological impulse for stimulation, acknowledge it, and let the feeling pass without acting. Protecting your capital requires the specific ability to observe your own impulse for stimulation without reacting to it. We have to dismantle the idea that trading is strictly the physical act of clicking buttons. This chart breaks down the reality of professional trading. What you see is the waiting skill. Doing nothing is actually a highly active, demanding state of performance. When you elevate waiting to a core skill, you neutralize the biological urge for chaotic stimulation. You are no longer bored. You are executing the waiting phase of your plan. To defend against slow markets, you must use a technique called environment design. If the market lacks valid stimulation, you physically and mentally design your workspace to prevent impulsive clicking before the boredom even sets in. Here is the practical step you can apply immediately. Before the trading session even begins, explicitly define what waiting correctly looks like for you. This might mean stepping away from the desk entirely when volume drops. It could mean keeping a book nearby to channel your attention, or minimizing your charts and relying purely on automated price alerts. So as you prepare for your next session, ask yourself, do you trade because there is an edge or because nothing is happening? This is educational content only, not financial advice.